Hey everyone, and welcome to today's Explainer. I am incredibly excited about this one, mainly because we're tackling a question that is pretty much on everybody's mind right now. I mean, we all know large language models, or LLMs, are doing some absolutely amazing things, right? They can write complex code, they can summarize massive, dense books in seconds, and frankly, they're making a lot of us a little nervous about our day jobs. They just seem incredibly smart. But are they actually smart enough to handle the chaotic, high-stakes, real-time arena of the global stock market? Well, today we're breaking down a really fascinating research paper titled AI Trader, Benchmarking Autonomous Agents in Financial Markets, which was put together by researcher Qianyu Fan and a team of 5 other authors. We're going to find out exactly what happens when you literally let AI off the leash in live trading. So it's the ultimate test, isn't it? If AI is just so smart, can it beat the stock market? This brings us to a massive myth versus reality showdown. We often have this myth stuck in our heads because we interact with these chatbots every single day. They sound incredibly eloquent, they can write you a perfect poem, and they instantly pull up obscure facts. So we naturally just assume, wow, they must be omnipotent geniuses ready to conquer literally any field. But high-stakes finance isn't just about knowing facts or sounding confident. It's about making split-second decisions when millions of dollars are on the line and market conditions are literally changing by the millisecond. We really need to figure out if these autonomous agents are truly ready for Wall Street, or if all that eloquent reasoning is just masking an inability to handle real-world chaos. Okay, let's dive into this. Here's our roadmap for today. First, we'll look at the live market problem. Then, introducing the AI Trader benchmark, the minimal information paradigm the researchers used, the striking findings they uncovered, and finally, the future of autonomous agents. Let's get right to it. Let's kick things off with part 1, the live market problem, structured smarts versus market chaos. So the researchers identified a pretty massive gap in how we actually evaluate artificial intelligence right now. Think of it kind of like taking the bar exam versus surviving on a real trading floor. With structured tasks, things like taking a standardized test or summarizing a static document, we are dealing with completely predictable environments. The rules simply do not change while the AI is taking the test. And LLMs are getting unbelievably good at these, often hitting human expert levels. But live financial markets, totally different beast. A trading floor is essentially a living, breathing organism. It's a fully dynamic environment where decision-making is incredibly challenging because it requires real-time information integration and immediate adaptive responses. Algorithms are reacting to breaking news while simultaneously reacting to other algorithms reacting to that exact same news. Until now, there's just been a critical lack of systematic benchmarking to test AI in these wild, unpredictable conditions where strategic responsiveness is absolutely mandatory. So how in the world do we actually test for that kind of chaos? That brings us to Section 2, Introducing AI Trader, the new evaluation standard. To fix this critical evaluation gap, the researchers created AI Trader. This is defined as the first fully automated, live and data-uncontaminated evaluation benchmark for LLM agents in financial decision-making. And I really want to emphasize that word, data-uncontaminated. This is actually a massive issue in AI research right now. Think of data contamination like secretly giving a student the answer key before they take their final exam. If an AI read all of 2023's financial news and stock movements during its initial training phase, well, of course it's going to look like a genius trader when you test it on 2023 data. It literally just memorized the past. AI Trader completely prevents this. It forces the AI to prove itself in a true live scenario with entirely unseen data. And they didn't just test this in some safe, predictable little sandbox. No way. To truly simulate live financial environments and prove these results weren't just a fluke, AI Trader spans 3 distinct major financial markets. First, you've got U.S. stocks, which are highly institutional and driven by algorithms. Second, A-shares. Those are domestic Chinese stocks, which are notoriously retail-heavy and heavily influenced by local policy. And third, cryptocurrencies, the ultimate Wild West of 24/7 highly volatile trading. By dropping these agents into such vastly different market structures and at multiple different trading speeds, the researchers created an absolute crucible. It is a comprehensive, multi-market stress test for artificial intelligence. Moving right along to Section 3, the minimal information paradigm. Basically, surviving without human help. And this brilliantly illustrates how the researchers made absolutely sure the AI was acting autonomously. They implemented what they call a revolutionary, fully autonomous minimal information paradigm. I want you to just imagine dropping an AI agent directly into a high-speed trading terminal. It wakes up, it does not get a neat prepackaged summary of the day's events. First, it receives only the absolute bare minimum context. Then, step 2, it has to independently search the live web for real-time market information. Step 3, it has to actually verify that information, figuring out, hey, is this headline legitimate news or just some fake rumor spreading like wildfire on social media? And finally, step 4, it must synthesize all of this chaotic data to make a buy or sell decision in a matter of milliseconds. The whole shebang happens completely without human intervention. Under these incredibly intense minimal information conditions, the researchers evaluated exactly 6 mainstream large language models. So that's 6 different agents dropped into 3 different live markets across multiple trading frequencies with absolutely zero human help. So how did they do? Which brings us to Section 4, the striking findings. And you might want to prepare yourselves because the reality check delivered by this benchmark is incredibly eye-opening. The paper reveals a fundamental disconnect between 2 concepts that we honestly confuse all the time. There is general intelligence, which encompasses advanced reasoning and the ability to orchestrate complex coding tools. These models absolutely possess that, for sure. But then there is effective trading capability. The researchers explicitly state that general intelligence absolutely does not automatically translate into effective trading capability. I mean, just because an agent can write Python code or debate philosophy with you in a chat window does not mean it won't completely panic when a stock price drops 2% in 60 seconds. Real-time adaptation and risk management are entirely different skill sets. So the crucial point is this. Most agents exhibit poor returns and really weak risk management. Let that sink in for a second. When you strip them of their structured environments and force them to synthesize live data completely independently, these highly advanced systems largely failed to make money, and even more importantly, they failed to protect it. What did this actually look like in practice? Well, it meant these systems often failed to use even the most basic protective measures. They might buy into a massive hype cycle right at the peak of a bubble, and when the assets started plummeting, instead of using a stop loss to just cut their losses, they just held on, watching the value completely evaporate. In real-world finance, this kind of weak risk management doesn't just mean a bad score on some academic benchmark. It means catastrophic real-world financial losses. But there was also a really fascinating nuance to their performance, and it depended on exactly where they were trading. The researchers demonstrated that AI trading strategies achieve excess returns much more readily in highly liquid markets than they do in policy-driven environments. Now, why does that happen? Well, in highly liquid markets, think your massive US tech stocks. There's just a huge volume of trades happening every single second. That creates relatively clear, mathematically predictable data signals. The AI actually has a fighting chance to find a statistical edge there. But in policy-driven markets, where you have human government intervention, sudden regulatory shifts, or totally unpredictable institutional behaviors, the AI just falls apart. It fundamentally struggles to predict human regulatory whims and the sudden market shocks that always follow them. So if they're failing in these chaotic environments right now, what happens next? Section 5. The future of autonomous agents. Where do we go from here? Now, what's really interesting about this is a direct, fundamental finding from the research. They state, and I quote, risk control capability determines cross-market robustness. If we ever want to build an AI agent that can reliably operate across U.S. stocks, domestic A-shares, wild crypto markets, and whatever asset class comes next, it all comes down to mastering risk. Risk is the absolute key here. If an AI cannot master risk control, its incredible reasoning intelligence in other areas simply is not going to matter the second the market turns against its initial prediction. Ultimately, what you should really take away from this explainer is that this paper is a massive step forward for the entire field of artificial intelligence. By explicitly identifying these critical limitations in current autonomous agents, the researchers have provided clear directions for future improvements. We now know exactly where these models fall short in dynamic environments. And the best part? The authors have entirely open-sourced their code and their evaluation data. This means that while Wall Street AI agents might not be ready to replace human traders tomorrow morning, thousands of developers worldwide are going to take this benchmark and immediately start building safer, more robust, and far more capable agents designed to fix these exact flaws. We have seen today that while AI possesses immense general intelligence, the dynamic, real-time pressure cooker of global financial markets reveals a really glaring weakness in risk management and adaptability. The technology just isn't quite there yet when it comes to navigating absolute real-world chaos. So, I'm going to leave you with this final thought. Until AI truly masters risk, is the trading floor still a human game? Thank you so much for joining me for this explainer. Keep questioning, keep learning, and I'll catch you next time.